If there is one piece of financial advice that nearly every expert agrees on, it is this: low-cost index funds are the most reliable engine for building wealth. That philosophy was pioneered by Jack Bogle, who proved that simply buying the entire market beats trying to pick individual winning stocks. But the moment you decide to follow that advice, you run into a wall of acronyms. Suddenly you have to choose between VOO, VTI, SPY, and a dozen other tickers that all claim to be the definitive index strategy. It creates a paradox. You set out looking for a simple, automated way to invest your money, but the sheer volume of choices leaves you completely paralyzed. On one side, you have minimalists recommending a single S&P 500 ETF. On the other side, purists insist you need a strict multi-asset architecture known as the three-fund portfolio. Debating the math of these strategies is pointless if the complexity keeps your money sitting in cash. The best portfolio is simply the one that gets you to invest your first dollar today. Behavioral failure, your own reaction to market stress, poses a far greater threat to your wealth than any economic recession. Behavioral failure usually happens for two reasons. First, your investment strategy is too complicated to manage. If it requires constant manual tweaking, you will eventually neglect it, leaving your assets dangerously unbalanced over time. The second trigger is a portfolio that is too volatile. If you cannot stomach wild swings in your net worth, you will inevitably panic sell at the exact bottom of a market downturn. To fix this, we need to dismantle the three dominant passive ETF strategies and map them directly to your personal psychological resilience. Your portfolio success hinges on whether its design can withstand 30 years of your own human psychology. Let us start with the simplest option, the one-fund domestic approach. This means putting all your equity into a single U.S. large-cap or total market exchange-traded fund, like Vanguard's VOO or VTI. The primary advantage here is cost. These funds charge an ultra-low expense ratio, often around 0.03%. An expense ratio is the annual fee that all funds charge their shareholders to cover management and administrative costs. Keeping this number low minimizes the fee drag on your money over decades. By buying that single ticker, you capture the absolute totality of U.S. economic growth, and it requires zero ongoing maintenance from you. This proportional chart of the S&P 500 shows just 7 massive tech blocks consuming a disproportionate percentage of the total index weight. Because these indexes are cap-weighted, your supposedly diversified portfolio is actually making a highly concentrated bet on a small handful of technology giants. When you rely this heavily on a single sector, you leave yourself vulnerable to a specific industry collapse, similar to the massive losses investors suffered when the tech bubble burst in the early 2000s. The one-fund domestic approach offers the ultimate operational ease, but it masks severe vulnerabilities if the top-heavy tech sector experiences a prolonged downturn. That brings us to the second strategy, adding a global buffer. This means allocating 20 to 40% of your stock portfolio to an international ETF, like VXUS. Mathematically, this legally decouples a portion of your wealth from absolute reliance on the United States economy. However, there is a direct trade-off. Holding international assets introduces currency exchange risks. It also practically guarantees that your total portfolio returns will significantly trail behind during explosive domestic bull markets. This creates a severe psychological hurdle known as tracking regret. It is the emotional frustration of maintaining discipline and holding an underperforming international asset for a decade while watching your neighbor's domestic stock soar. Adding a global buffer is a straightforward transaction. You are explicitly exchanging maximum domestic growth potential for protection against geographical stagnation. Strategy 3 is the classic three-fund portfolio, which finalizes the triad by adding a total bond market ETF, like BND. Bonds act as a critical fixed-income shock absorber. When the stock market crashes, bonds provide stability, drastically reducing the severity of your overall portfolio drawdowns. But this introduces operational friction. The three-fund approach permanently revokes your set-and-forget status, demanding manual spreadsheet math at least once a year to rebalance your assets back to their target ratios. Beyond deciding which assets to hold, we need to address the structural vehicle you use to hold them. You have to choose between an ETF and a traditional mutual fund. If you hold a mutual fund in a standard taxable brokerage account, you face a major problem. When other investors sell their shares, the fund manager is forced to sell underlying assets to generate cash for those redemptions. This triggers taxable capital gains events for everyone in the fund, even if you never sold a single share. ETFs use in-kind creation, exchanging securities with institutional investors rather than selling assets for cash. While the mutual fund leaks taxable capital gains, the ETF seamlessly swaps assets, emitting zero tax leakage. This defers taxes for decades, allowing a larger capital base to compound uninterrupted. For the absolute optimizer, investing outside of a tax-advantaged retirement account, utilizing the ETF architecture is a non-negotiable requirement for maximum long-term wealth retention. This diagram represents your decision matrix. Let us strip away the economic theory and map these options directly to your personal breaking points. The first node is the tax test. Is this money going into a taxable brokerage account? If yes, you must strictly route your money to ETFs. If no, because the money is in an IRA or a 401k, mutual funds are acceptable. Next is the maintenance test. Will you realistically log into your account once a year to run the rebalancing math? If the answer is no, you are a minimalist. Route directly to the one fund approach. You must accept concentration risk in exchange for guaranteed, friction-free market participation. If you answered yes, you move to the volatility test. Can you watch your net worth drop by 40% without liquidating your account in a panic? If the answer is no, you are a prudent builder. You belong in the classic three-fund portfolio. You will accept the mathematical drag of bonds in exchange for your emotional survival during market crashes. And if you answered yes to the volatility test, you route to a 100% global equity split, maximizing growth while protecting yourself from regional stagnation. Brutal self-awareness regarding your own laziness and fear is a far better predictor of financial success than selecting the mathematically superior ticker symbol. The ideal strategy is simply the one you can reliably execute without deviation for 30 years. Time in the market is the ultimate compounding force. Holding your assets steadily through years of market chaos renders minor optimization debates completely irrelevant. Executing a good enough portfolio today will permanently outperform a perfect portfolio that is delayed by analysis paralysis. Pick your path, automate your deposits, and let the market work.